Hello guys, and glad to have you on board again. Today we have to talk about the VIX movements yesterday. Of course, it's still hard to figure out if this is really going to be the beginning of something bigger or just another set things on fire and actually immediately right after turn off the input and just basically dry out of volatility. So we'll talk about that because that was part of our year plan, and just like we stated on this 2021 forecast, this is hardly going to be a predictable year in terms of timings. On my personal anticipations, I figure out that there are possibly going to be up to 3 swing trades throughout the year, scattered with unpredictable timings. But I just try to give you as clear as possible all of the technical informations that I would proceed to forecast the probability of these swings to show up in a nearby future. And we've assessed the probability and likelihood of an extreme sentiment shift towards some negative tented sentiment after terminating 2020 at the highest. We've also assessed the probability that we could have some kind of a rippling effect of 2021's euphoric behaviors throughout 2021 early stages. That's exactly what we've had throughout January. And we've also stated back then that looking at getting into February or something, we could have some early negative reactions. And I think that's exactly what we're experiencing right now. So is it really the beginning of something much bigger than we anticipated? So it's more about now going and diving into subjective territory, trying to let you understand how I'm measuring the real risks out of derivative pricings. And specifically, the VIX is one of the factors we've talked about. But this is definitely not the only one. We massively have been talking about a separate stuff, which is, of course, once again, pretty damn subjective as well, using the sentiment as a driver for our timings through 2021 on stock markets. And even though we see that there is a flashing red fucking light into the VIX, this is daily chart, and we've closed right at the market top into significantly much higher levels than we've experienced previously. 61% increase on a daily basis for the VIX is definitely not something we've seen for a long time. The last time we've seen something similar was back then, and we were right in the middle of COVID crisis, and it's basically, I still tend to believe that this was irrational short selling on the VIX because of massive liquidity injections, but I still tend to believe that we've made some mistakes in the past that we're going to have to pay for in the future. The question is when, and do we have to move on with the schedule, or do we need to stick with the initial plan, which would be we will probably get to find a irrational bearish behavior and sentiment likelihood to happen onto supportive areas in the S&P 500 and other eventually major stock markets indices, and we would very likely get to buy these because of this irrational behavior. We've also assessed the fact that there are still some risks over 2021, limited, but still some existing risks. So we simply cannot go all in like, okay, the stock market's going down, people are panicking, we just buy the shit and wait. That's definitely not how it works. We must not put our money entirely in the market because there is still, even though it's a reasonably low level, probabilities in which the entire financial system just goes to collapse. And this, in that perspective, will turn out valuation to much, much lower levels than they currently are. And if this happens, we need to have cash available to buy these much lower prices. Okay, so that was the plan. So what about the fucking VIX? Is this just yet another set things on fire to just destroy volatility later on and set ourselves below 20, which is a possibility because as long as we do not break a resistance, there is still a fairly much likely probability in which we get down there. But I would tend to say that depends on where we close the week. So it all depends on today and tomorrow's closure because, of course, in this daily chart, the trend channel is updated depending on the weekly candle closes, okay? So what we've made in here is clearly a problem because we've set it ourselves far away from the trending behavior. We should have found some kind of a resistance out of 30, and that's what we were dealing with previously. We've said that 20 is a support, 30 is a resistance. We might oscillate in between with a likelier probability to try inching below 20 because that was the trend channel's direction. So what happened yesterday just totally fucked up this probability. The thing is this, if we get to close the week above that, we're definitely going to reverse the trend channel and putting it into a positive direction, which will mean that we'll get into buying VIX supports instead of trying to sell resistances. So that could change the plans. And it all depends on what's going to happen today and tomorrow. So big question marks over these two things. VIX has sent us a strong message, but has to be pushed through between today and tomorrow's sessions. Okay, so not a red flag, but just a seriously change of plans if this thing is not an irrational behavior. If we're like in here, if 2 days later we would be pricing VIX back into the 29 or below 30 area, this could just be an overrated bullishness in the VIX or bearishness in the S&P 500. That's the reason why we need to jump immediately into sentiment indicators. And as you can see, sentiment is seriously deteriorating though, which lead me to believe that we had two plans. The first one being we could eventually retrace back up 80 into extreme greed territory, in which we're very likely going to find kind of a divergence pattern in which the sentiment certainly doesn't top up what we've experienced late 2020, but still we get into high territory in which we get overbought and we get to retrace down to some more fearing context in which we thought that there would be a very likely probability in which we get below this level, very likely to get to dip below 20, which would be extreme fear territory, in which we're very likely going to find some interesting supports, of course, requiring the dumb money to do the opposite, meaning that the dumb money has been getting net short into a market that just drive itself up in a 45-degree angle trend day after day, slowly but steadily grinding our way up as the retail traders are getting against that. But they haven't seriously increased their net bearish exposition. They basically just stand still. As the market goes up, they're selling. As the market tries to retrace a little bit, they're buying. And they're just basically oscillating in between, just always doing the opposite of what the market does on a day-to-day job, which was our day-to-day plan to just trade against them. But in order to go for a swing, we really need a much bigger stuff. We need to see the market going down, and we need to see the retail traders getting net bullish, meaning this line getting to cross over 50. These oscillator getting to cross as well. If we get that, I think that getting below 20 in the sentiment and driving S&P 500 price towards supportive areas would be the sign of a potential first 21 swing to come. Okay, so that means just looking at how the VIX reacted on a day basis, okay, means that we've priced in volatility to a level that is so big that we don't even see something in the charts in here. Yesterday's drop down is so insignificant that it basically barely is even seen. We haven't even retraced to the lower 50% of the trend channel, but the sentiment, the VIX, the volatility derivative sentiment is skyrocketed already. So there is a clear divergence between the two. One of these two is wrong. Either today the S&P 500 will drop another 2 to 2.5% to get to test some first supports, or the VIX has really gone really too high too soon. So we'll see about that, but I'm experiencing a lot of question marks over today's and tomorrow's session. That's the reason why you need to be real cautious, but that's also the reason why I'm moving ahead with another schedule, which is we're going to have to give a narrow list into our buyable assets. Because if we get to retrace to some more supportive areas, and even if we do it real quick, we're going to have to be prepared. For those who have an investment portfolio, this is something we have to do as fast as possible, trying to give ourselves into a narrow list of, like, say, for example, 10 to 20 assets at best. This is my personal list. Okay, those in gray are the ones I already have, in which I can eventually consider tiny reinforcements on some specific cases. The green ones are the one I still don't have, but getting interested about. So have yourself, put yourself into this mindset. Have a list of approximately 10 to 20 assets at best. Don't go any way further than that. Just make sure you have your short list on these guys, so that if the timing shows up inappropriately, like you're getting surprised by the immediate burst of volatility, then if it actually turned out to show up within the next 48 hours or eventually just next week, or even if it doesn't show up at all, you have to be prepared. So you act instead of react. And that's exactly the only rational thing you have to do today. Don't rush yourself. Don't get the adrenaline shot like, oh man, something's going to happen. I want to be in. That's definitely not the appropriate reaction. The appropriate reaction is just getting yourself fucking prepared just in case it show up earlier than expected. Okay? So do that today. Don't rush yourself. Don't get excited. Just make yourself a narrow list of 10 to 20 assets you are eventually looking at buying. If we do have some more attractive prices on the global stock market prices, okay? Of course, define the earlier supports in which you're willing to buy. Like, let's say, for example, I'm talking about Santander. What are the prices I'm willing to buy on these assets if I want to get in? Well, current prices are pretty much already attractive. So it's more like if we get down there, I'm already on supports, I'm just going to buy the shit. Okay, it's really all about that. Of course, make yourself a plan. Try to figure out how long you're willing to hold on to these things. What are your targets? Where do you think invalidations could trigger and stuff like that? Okay, but look for the next potential supportive areas on the assets you're looking at buying. For example, in my personal portfolio, Santander is definitely an area I'm looking at buying. We are squeezing the momentum, which means if this area is broken through, then I'm going to ask for the major support. So it mostly depends on what's going to show up. And like I said, there are already attractive prices out there. So if this asset isn't dropping like shit when the rest of the stock market is falling, then it's already into attractive price territory. Okay? Let's take another example. Logitech, quite crazy fucking overbought. I'm looking at some pullbacks on those assets to get to buy these. Remember that I never buy into the top 50% of the trend channel. So there is a trend in here, but I'm still looking at some pullbacks to get myself into this. So patience, and if this one doesn't provide attractive prices when the time comes, I'm just not going to buy. It's not blindly buying in just because you want to. It's looking at opportunities and preparing yourself, because we know that there is a very likely probability in which the stock market reactions might turn very irrational in terms of sentiments and probably not going to last very long. Remember that the stock market is, for now, and at least recently has been, into charts in which anytime we get to interesting price areas and supportive prices, we lack of supply, not enough people selling, which means we rapidly V-shape reverse. Okay? So that's the motive, that's the plan. Remember that we're also trading a global plan in which the likely probability is for us to have made an extended wave one, which means we might be on the verge to buy overlapped areas, so don't be too bearish either, okay? So that's really all about that. That being said, a quick word about cryptos. Everyone is still driving their stuff crazy because the prices are going down. Remember that my personal forecast was in this range. We would pretty much set on course for most of our time spent below 34K. So that's exactly what we're doing. When I told you there is no rush to get to buy the dips and looking for V-shaped reverse, we're not lacking of supply into these assets. We're mostly having irrational demands. So we're neutralizing it before getting into push higher. That's my still most probable forecast. So being fucking patient is what we need to do, having a goddamn plan. 27K is the next area we're going to deal with only with the experienced traders. Others should definitely just stay the fuck away and wait for us to see whatever happens out there, because it could definitely not happen as well. So don't get yourself into blindly buying this area. As we get a support, the likely probability into these types of markets is a triangle. So triangle means there is no fucking rush for you to jump in. It's really more about get some patience and wait. You don't need to catch this dip. You will have much more less risky and attractive prices down the road. You're still not going to get the best possible price. But do you really want to get in at 27K when there is very likely going to be another below 30K dip later on with much better visibility? So that's really all about it. In terms of asset risk pricing, taking risk reward ratios, this one is a much more attractive trade to take, much more globally tradable by less experienced traders. But this one's really for smart money managers and experienced traders, nothing else. Okay? So don't try to short sell to get there. Don't try to buy the dip. Just stay the fuck away. is what you need to do into cryptos. Market prices are still fairly much supported. We do have trending behaviors. This is totally confirming what I thought. This market is probably trending, but we have gone too fast, too far. We're going to have to drop down and reduce volatility, which means boring, stupid ranges, and people will drive themselves crazy into this. That's exactly what we've told on the 1st of January, and that's exactly what's happening right now. People are getting impatient and they're getting nervous. They're getting to fear of uncertainty because they thought they knew what the market wanted to be doing. They knew the momentum was meaning directional trades, and now that we're lack of this momentum, they're asking themselves question. Maybe this market is bearish, maybe this market is going to reactivate real quick and I'm going to have to be in, but they forget about the most probable stuff. We're probably just going to stay there and boringly put people at impatience and fear of uncertainty biases. So they're just going to do some stupid mistake and we're just going to reduce tributes. That's really what I think is all about, shuffling the decks and distribute to some other people. It's more importantly that the dumb money managers right now, those who are fearing of uncertainty and lack of patience, will basically just make mistakes that will put their money into someone else's hand, very likely into some more patient and rational trading hands. So it's more about that. I think there's a lot of dumb money trading the market right now. They're just going to lose money as time passes and give it to me. So that's really all this is about. Be smart. And at some point, not doing anything is the smart decision you can make. Okay? That being said, I wish you guys a pleasant day. Trade smart, but don't trade hard right now. There are really a lot of early signs of stupidity down the corner. So just try to put yourself into a corner in which you don't have to make stupid decisions. That means being prepared if you want to buy on long-term assets investments, if you have an investment portfolio. If you don't have that, and if you're just a short-term speculator, then brace yourselves because you know that volatility can show up. So reduce your position sizing, don't be stubborn, and that should be it. That should be fine. Okay? Bye, guys.